Good morning and welcome to this Wednesday, June 23rd, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Boy, June 23rd, hard to believe. Well into summer now, just started actually, but feels like been into it for a little while. Of course, the market over the summertime does tend to take a little bit of time off, but secular bull market seems to know no restrictions and no bounds as it continues to power ahead. Yesterday, we saw the NASDAQ closing at an all-time high. I think that really bodes well for the market right now. When I start seeing all-time high breakouts, I'd really pay little attention to the calendar. The market action, the price action dictates to me much more so than the historical seasonal patterns do. That's more of a secondary indicator. Obviously, price and volume, number one in my book. We're going to get into that breakout and take a look at the NASDAQ and some of the things leading it in just a bit. But before we get going, let me go ahead and take you over to Earnings Beats for those of you who are new. Love to have you join our community if you're not already a part of it. We do have a free newsletter. You can simply type in your name, email address there, hit the subscribe button. We publish a newsletter Mondays, Wednesdays, and Fridays, usually very brief, dealing with relative strength earnings, breakouts, anything of a technical nature. And we try to keep it very, very educational, but there are trading opportunities within those newsletter articles as well, if you're so inclined. Let's take a look at what happened on Tuesday. We saw the Dow Jones Industrial Average up 68 points, bouncing again for the second straight day. Got a key overhead resistance coming in on the Dow. You see that death cross where the 20-day just crossed below the 50-day. We hadn't seen that in a while on the Dow, and price actions below both of them. So unless we can, get right back up above, I think you have to at least in the short term respect it. Now, the one thing that I think is positive right now, and the reason I think that the Dow is going to go through those moving averages, is that we're really not seeing that problem on the S&P and the NASDAQ. The S&P 500, strong day yesterday, on the verge of another all-time high close. The NASDAQ set an all-time high close yesterday, up 112 points. Up about 0.8%, which was better than both the S&P and the Dow. Mid caps, small caps on a relative basis didn't do as well, although they were higher. And they too coming up underneath, trying to get through moving averages. The mid caps have seen that death cross. The small caps have not. But I still believe that the overall direction of the market is to the upside. And I think we're going to see those other moving averages, the ones that are struggling with those moving averages, I actually think we'll see those major indices move back through both the 20 and the 50-day. All right, looking at the sectors, and this is where things started to get exciting for me. The discretionary group up was actually leading yesterday, up nearly 1%. Broke out of this little sideways area. We'll talk about that more in just a bit. Technology up also about 0.9%, all-time high close on the XLK. Good news there. Communication services actually has been fairly strong all along. It too had a nice day, up almost 0.9%, and not too far away from breaking out to another all-time high. Energy, crude oil prices just keep going up. We've now made $6 of that $10 breakout run in crude oil. When it broke above $67, I think it was an ascending triangle breakout, measured to $77. It's now well above 73. So it is on its way. Don't know that we'll get a whole lot more out of energy, but at least for now, it is continuing to perform well, still in a nice uptrend. We'll see if we can get through that $56 level. I think that's going to be a key area on the XLE, not just in the short term, but if you go back, look at a longer term chart, I think you'll see 56 and a half, that area posing some interesting resistance. We'll see if we can get through it. Also wanted to mention within the discretionary group, broadline retail closed at an all-time high. So been struggling, been consolidating for a long time, mostly because of Amazon. but we did get that breakout on broadline retail yesterday at the close. I think that bodes very well, not just for broadline retail, but for retail in general and also for discretionary stocks. 10-year Treasury yield. Let's get an update, make sure we got the latest there. June PMI composite due out 67.9, the estimate. May was 68.1. So we're looking for just a slight drop there. And then 10 a.m. May new home sales will be out. April was 863,000 units. We're expecting a slight increase to 881,000 units in May. So we'll see what happens with that. 10-year Treasury yield up a bit today, up about 1 basis point, 1.49%. I think now we've gotten a top 175. I expected we'd consolidate breakout. That did not happen. We consolidated, actually broke down. So I'm kind of lowering my expectations in the near term on the U.S. Treasury yield. I think probably 140 to maybe this 160 area. We'll see which way we break there. 140 short term, there was a gap support. You can see the yield had jumped from back in early March from 140, went straight up to about 175 in about 2 weeks, never went back to that 140 level. Seems like maybe we could threaten that area. And if we stay low, that is going to continue to help areas like technology and consumer discretionary. All right, moving on, talking technically. Well, we like to look at this IWF IWD chart. I can say a couple of things about this chart. Number one, I think the downtrend line's been broken. Number two, we have a double bottom in play. Needed to get back through this intra-period high, which was about 1.69. We hit 170, continuing to point up. I love this move, the 20 crossing through the 50, and then look at that relative momentum. The daily PPO on this ratio is at the highest level we've seen all the way since back in September. So momentum is absolutely picking up in these growth stocks, breaking out on the XLY and the XLK. I think when you combine all this together, I think that the risks are now beginning to turn to not being in the group rather than being in the group. So for the last several months, really, but especially since February when we broke down below this 170 level, things really got very rough on the growth stocks. We've seen them go through this period of consolidation, and it looks to me like we are getting this breakout to the upside. Keep in mind too, and I'm actually doing a lot of historical work right now on all the sectors. A lot of the, how I show the S&P 500 and the NASDAQ, how they trade throughout the month and throughout the year. I'm doing a lot of that same information with all 11 sectors and should have some of that information out, be talking about that in the future. But what I can say is that one of the things I'm looking at are the sectors in terms of pre-earnings runs, and technology and consumer discretionary both like these pre-earnings runs. They tend to outperform. So here we are, June 23rd. We are now, I don't know, maybe 4 weeks away from when earnings really start to kick in. And this is the time when we start to see pre-earnings run. So I would not ignore the fact that we've got technology breaking out, consumer discretionary, even in the short term, making a breakout. This ratio accelerating to the upside. I think a lot of signs are starting to point more and more toward this being a for real move in growth stocks. So take note. Let's move on and talk a little bit about discretionary. So discretionary, you can see this gap right here. And this was back on May the 10th. And remember, this is when a lot of that inflation stuff was happening. And that's when we took this big hit. But we had closed on May 10th at 174.20. And after that gap down, look at the volume coming in on this selling. Now, a couple of things here. First, on this big move to the downside, the AD line really didn't take that big a hit. And in fact, we broke out on the AD line to a new high probably a week or two ago, while the XLY was still down from its prior highs. So it's certainly giving us the indication that these stocks were being accumulated throughout this recent weakness. And it makes sense as we now begin to move toward earnings. And now we're starting to get that push to the upside. When these groups move, I'm talking about the aggressive groups, XLK, XLY, they can move very quickly. If you look back at the end of March, right before we got into the pre-earnings run into April, the XLY here at the low was at 161. By the time earnings came out, 10% higher, 180. So if we're just starting a run, I mean, if you think 10%, I don't know if we'll go up 10%, but I think it's possible. That would take us up to about 190, over 190, 191, 192. So the XLY is certainly an area of the market. The consumer discretionary area is an area that I would be looking at pretty closely here. I like that move back up above the center line on the PPO. So we're starting to see bullish momentum pick up, and we just made it through this gap resistance. And that's what I was talking about the beginning of this discussion. That 174.20 or whatever it was, we closed at 174.86. Got as high as 175.55. I expect we're going to make a run for this 180 level and eventually make that breakout. All right, let's take a look at the XLK. Because the whoops, I don't know what happened there. Let's try this again. All right, so the XLK had to move up, little cup, handle, back near the 20-day, breakout. Now, I would have liked to have seen more volume coming into the XLK, but I don't pay as much attention to volume on ETFs as I do individual stocks, because the ETFs, I mean, they don't trade exactly like stocks. I mean, they do, but they don't. You know, they're a basket of stocks, so there could be heavy volume on some of the stocks that are breaking out within the XLK. Other stocks may not be trading with heavy volume. So you'd really have to look at the individual stocks within the XLK, I think, to really make a true and full assessment of volume. Because the volume of the ETF, the ETF is going to follow the basket of stocks. It's not going to follow the volume coming into the XLK. So that at least is something to be thinking about. But the pattern itself, very strong. I love this cup, the handle, the breakout, and the fact that we're now 4 weeks from earnings season. Just knowing the history of the market, technology tends to do very well end of June into the month of July. So we'll see what happens here. Let me also pull up that NASDAQ for you, because what I see here, and this is really bullish, I would be a big fan of the QQQ right now. We pull up this chart here. I mean, I think what you'll see, equal highs, higher lows. So off of this huge advance, we have had this lengthy consolidation period since February, 3 equal highs coming across, right around 14,200. Higher lows in play. This is a perfect ascending triangle. A, B, C, D, E, breaking out. This measures from 14,200 down to about 12,400. That's 1,800 points, which would take us to 16,000. That would be the measurement on this ascending triangle breakout. So think about that for a second. If it gets 16,000, I think you're going to want to be in technology and consumer discretionary, communication services, the QQQ. I mean, these are the types of things. And if we look back at that IWF, IWD at the bottom of this chart, here's the QQQ spider. See how we were going down, had the lower low. Well, we're right back up here at this high. We've gotten the breakout in the QQQ, or the breakout in the NASDAQ. Can we get the breakout in this ratio? That's one thing I'd be looking for as just further confirmation of what we're seeing already in the market. In secular bull market advances, if you study history, you'll see that technology, consumer discretionary, communication services, those types of aggressive areas of the market, even financials and industrials to a lesser extent, they lead the market to the upside. So these are areas that I personally would be looking at. These are areas that I am investing in. And I think it is worthy of consideration given what's been taking place. All right, let's look at the relative strength of these sectors. So this is the relative strength sector chart list that I have and that we share along with the industry group. We'll look at that one in just a minute. But this is technology, and you can see relative to the spider, we've now moved back above both moving averages. Look at this cross that's taken place over the trigger line. Now, this is the PPO. This is the relative PPO. So it's not the PPO of the XLK. It's the PPO of the XLK divided by the S&P 500. So it's a relative PPO. But if you notice, since September, we have been below this trigger line. This dark black line is below the 9-day moving average. That's considered the trigger line. So we've been continually moving down and down and down below it. We just made a cross back to the upside. Now, if we had followed these crosses to the downside, well, first of all, if we had followed this on the move up, we would have been in technology throughout that whole huge move throughout the pandemic. If you followed this to the downside, you would have basically stayed out of technology when it wasn't performing well. Well, we're just getting that signal again that it's time to be in. Consumer discretionary, not the same, but improving. So this one's probably a little early, but I'm starting to see the price breakout. Starting to see some of the areas like broadline retail moving to an all-time high. Some of these key areas that led consumer discretionary back in 2020 are starting to show signs of leadership again. So this one is a little bit more of a leap of faith than it is actually seeing the confirmation at this point. So if you think, well, maybe it's a little early, I can't really dispute that. I think this one's a little tougher call than technology, but I do see signs that we are making moves to the upside in consumer discretionary. So I definitely want to have representation. The other thing I would just suggest here is that while it has been weak, consumer discretionary is not like utilities, real estate, consumer staples. This is not a group that tends to underperform for very long in secular bull markets. So when we start to see early signs of strength, I tend to take note of that. So combining a little bit with what I'm seeing on the charts and just knowing a little bit with, how secular bull markets unfold. The last one I'll show you, communication services. This one's continued to do well. So not really any changes here. I think communication services looks good. Moving on to the industry groups. So what looks good, what doesn't look so good? Computer services, for the first time in a long time, is actually showing some pretty nice leadership here over the past few months. If we look at the chart, I mean, we've already had the absolute breakout, finally got through key levels probably a couple of months ago, but this group continues to move up and it's showing relative strength. Some of the stocks in this group that you might consider would be something like a Zoom, which has also shown renewed leadership. That would be something that, well, I'll just say, I mean, I own Zoom, have for a while, traded it there for a period of time, but I've been back in it for a while, and I like the stock. I think it goes higher. Let's move on to other areas within technology. How about semis? Remember, semis were weak for a while. Well, they've moved back up above their moving averages. I would say the relative bounce has been okay, nothing great. And if you look at their absolute chart, we do still need to see a breakout. So we've been consolidating for the past few months. But watch, because if we do get this breakout, we're getting great leadership. Stocks like NVIDIA doing extremely well right now. So that would be one. AMD has even picked up a little bit of late. You've got others in the semi-equipment area that have been consolidating, I think still look strong. Applied Materials, Lam Research, probably the one in that group that's been struggling on a relative basis has been KLA Corp, KLAC. But there are still a number of semiconductors, I think, that look good. Software has definitely picked back up again, moving back through both these moving averages. You can see a very solid cross of that trigger line. This has been an area that's been struggling for a while, had a little head fake here. So we do have to at least be aware, possibly a move back down. But again, I think when you combine what we're seeing with the fact that earnings start in 4 weeks, and historically, technology and consumer discretionary make moves heading into earnings season, I think when you combine all that, I really like what I'm seeing on these charts. Let's just keep moving here. A couple of others quickly. Electronic equipment's pulled back on a relative basis, but still tremendous long-term relative strength. It's hesitating right here around its relative 20-week EMA. You got that relative PPO back near the center line. I think this is still a group that's poised to do well. Computer hardware just moving back above its relative 20-week EMA, just looking to get this cross. And Apple tends to do well heading toward earnings. We're starting to see Apple pick up a little bit. So this is a group worth considering as well. All right, I'm going to move on because I want to go take a look at some of these discretionary areas. And I'm just going to look at the ones that are starting to show some nice relative strength. So let's just flip through here. Specialized consumer services starting to come off the bottom, but it's still way below the 20-day. I do like clothing and accessories. I've talked about this one recently. It's starting to turn back up. We got to get through both those moving averages, relative moving averages. But this is an area that moved up into year end, consolidated for a little while. And if we're starting to see discretionary move, this is a group I think that's certainly worth keeping an eye on. Recreational services has been doing okay, but this trade has kind of cooled off of late. So I'm going to pass on that one. Apparel retailers, I like this move back through the 50. We're back down near the center line. This is a group that I think could certainly make a move. I would be careful if we went back down and lost this relative low that we just established just a week ago. So if consumer discretionary is making a breakout and we're starting to see relative strength here, there's no need for this group to go back down. So apparel retailers is definitely a group I would be watching here. Specialty retailers turning up here on an absolute basis and on a relative basis. Got some work to do, but definitely starting to see signs here. Travel tourism's turned back down. That one was a surprise. Gambling stocks, this is a key area of relative support right in here. Starting to turn back up. I think if you go back down below about 0.205, I would be more concerned. Otherwise, I think this is a group that we may begin to see some nice strength out of. Home construction, I think this is going to depend a little bit on interest rates. We are at a key area where we could see a nice run in home construction. But if you're following the chart, we're trying to get through the 50-day, or excuse me, the 20-day moving average and been having some difficulty doing so. Broadline retail, definitely seeing some strength. Relative line went lower. The relative PPO line went higher. So we got a positive divergence. Last time this happened, January 20,000 or 2020, I should say. You can see the move down there, the higher PPO, and you can see what happened later. Now, I don't know if that's what we're going to see here, but I do think we're going to see a big move to the upside in broadline retail. I think this is going to be one of your leaders. We've already seen the break there. We've now seen that move above the trigger line, which again, it had been below for quite a while, hovered the last couple of months. Now we're starting to show some real strength with an absolute breakout. So I think that is all very good news for that area. Furnishings has pulled back a lot. We did have a relative negative divergence there. So I think we're pulling back, but I think this group longer term still looks pretty good. We had just made a massive move, 360 to 540, 50% in the index in 3 months. Got to give these areas that make moves like that time to digest gains. I don't think it's horrible that we've been seeing it pull back. We're seeing some profit taking. We're seeing other areas, the torch is being passed. I think overall, this is still a pretty good group. And once it regains strength, it's one you want to keep an eye on. Footwear, I think, is starting to make a turn to the upside. We did have a little bit of a false breakdown here, but notice we came back up through what should have been resistance. So that's why I think we had a false breakdown. Starting to turn up. Nike reports tomorrow. So keep an eye on that report. If Nike reports strongly and gets a nice reaction, I think we could have a relative bottom in on footwear. Better looking chart in footwear is Crocs, one of our portfolio stocks. Business training and employment agencies been trending higher, pulled back below the 20, but starting to turn back up. I think this group remains strong. The durable household products. I want to make sure this prior low, relative low over here holds. So it is possible we turn back up, but I don't know. This one starting to roll over in terms of momentum. I like some others better. Automobiles, this is an area I would certainly watch for. Tesla is starting to trend higher above its 20-day moving average. NIO, we've already seen a big move there. So this is a group that's been quiet for a while. Rotation. You want to get these groups before they turn and start making the move, not after they make a huge move. I think automobiles is very interesting at this point. And like I said, Tesla beginning to show some really positive signs. Almost through here. Recreational products starting to turn back up again. This is another area that I really like. I think we've just put in a bottom, nice little trend line test. I think recreational products goes higher from here. I like the relative strength beginning to build here in June. And we are still above the center line, even though we've kind of been going up above and below that trigger line. And I think the last one, auto parts, it's okay. Sideways consolidating. I don't think we've seen anything major. Good move here, turning back up again. But be careful if it were to go back down, say below 610. Otherwise, I think it's okay. All right. So I wanted to go through all of that because I do think that that is the big news from yesterday and what I'm taking away. NASDAQ breaking out, growth stocks returning to favor, technology breaking out, discretionary showing more and more bullish signals, earnings 4 weeks away. This is typically when we get, I did a thing not too long ago, an analysis of pre-earnings versus non-pre-earnings throughout the year. And the annualized return for roughly the 3 to 4 weeks leading up to earnings, the annualized return is 24% on the S&P 500. All other times of the year, it's 4%. This is the time when the stock market makes its hay. So be ready, be looking at these areas that are strengthening because this could be a great opportunity for us over the next 3 to 4 weeks. All right, couple of stocks that I'll mention. We've already talked about some of them. Amazon. I mean, Amazon didn't make the breakout, but Broadline Retail just did and moved through 35.50. I think heading toward earnings, we're going to get that breakout. I think Amazon breaks out this time. Now, if we fail, chances are we could move down, have one more 20-day test. I don't know if we get that. I'd be a buyer if we did. Lululemon. Making this breakout, coming down, establishing a neckline, head, right side of the neckline, right shoulder, breaking out. Lululemon looks good. Netflix, I don't really see any patterns, but I do like the volume picking up the past few days. We're now trending above the 20-day moving average, which is starting to turn higher. The PPO is just about to go positive. I think we need to get back through about 515. We got to 513 yesterday. If we can close above 515, I think we'll fill that gap to 550 and then go from there. Ulta, I see an ascending triangle pattern, equal highs, rising lows, maybe even equal lows. So maybe it's sideways consolidation, but I think we're going to get that breakout above 350. That would be very bullish on Ulta. I mentioned Tesla. Now on a short-term chart, you can't really see it. So I'm going to move this to about a 3-month chart. And on a 3-month chart, you can see that we are moving up and now we've been holding for about 3 or 4 straight days. We haven't done this in a while on Tesla. If we can get a close above 630.85, we haven't been able to do that. 630.85 would be your first target. I know it was up in pre-market. When I looked a little while ago, it was up $10. And then you've got that 50-day moving average, which is right now at 643.87. Those are the two areas that we need to be looking at to the upside, but definitely things are improving. Peloton, big breakout. We moved up had a little flag, bull flag above the 20-day moving average, broke out of it with increasing volume yesterday. And then I mentioned Zoom. Zoom's just been showing many more bullish tendencies. First of all, look at all the hollow candles. Hollow, to me, I just think immediately accumulation. On the way down, look at all these big filled candles. See the difference? So I'm seeing it much more as an uptrend. PPO looks good, trending above the 20, which is now pulling away from the 50. This is a nice looking chart, and I think Zoom continues to go higher. I mentioned Apple earlier. All those I just talked to you about, well, most of those I talked to you about were discretionary stocks. Apple starting to trend higher here above its 20-day moving average. It has a history of performing pretty well into earnings. Look at end of March, middle end of March, not really doing much. Heads toward earnings. There it goes. December made a move a little earlier and then pulled back into earnings, made a run with earnings. Here's the big move prior to October's earnings. Earnings coming out in October. So don't be surprised to see Apple continue to move higher. All right. Not much in the way of earnings. I will just show you a couple charts. We'll get an update. INFO. This is IHS market. And they came through, beat 81 cents versus 80. Stock was down pre-market about 1.5%. And it's about flat right now. But this stock, the trend looks really nice here. And now that earnings are out and they beat, my guess is anything off 20-day moving average would be a good entry. One company that did not beat was Patterson Dental. PDCO, they were expected to earn 53 cents. They came in at 38 cents. And hence the big move down. Sideways consolidation, relative strength, not really doing much versus medical supplies, not doing much versus the S&P, and not doing much in terms of reporting its earnings. Not a great number there. Winnebago, easy beat on the bottom line, 216 versus 176, but the reaction pretty muted and the stock remains in a downtrend. I would like to see with earnings, this stock get back up above its 20-day today. If it can go back, fill the gap, and then turn back up and break above the 20-day with that earnings report, perhaps we just saw the bottom. Failure at the 20-day, though, with this news out, moving back down to those lows, I would be careful, especially if those lows don't hold. All right, 3 you must see. Let me give you quickly 3 stocks to watch. Plug reported earnings yesterday. They weren't very good, actually. I mean, they missed on their bottom line, but the stock recovered nicely. We got an uptrend. Now we've got a cup. We're pulling back potentially into a handle. A breakout above about 34.35 would be very bullish for Plug going forward. Etsy starting to make some ground to the upside, moving sideways mostly. It's going to have some overhead resistance from about 184 up to about 190. But if we get through the 50, I think we're going to make it into that range. Then we'll see whether or not Etsy can get through. The last one, I think this was an Earnings Beats Digest article this morning. But this is a pretty nice breakout here. Sideways consolidating for many, many months. And now we get the breakout yesterday. Pulling back today, I think anything down to that 20-day moving average is a buy on Cintas. I believe we're going to see the stock move higher. Love this PPO just moving up from the center line. This is one I would expect to do quite well from here. All right, that is about it. Let me, let's see. Go over here, take a quick look at what's going on in the market. All right, we got the Dow up 23 points, S&P 5, NASDAQ another 36, so it is tacking on to its gains. So again, I think looks pretty good here with this breakout area. I think we're going to see that move based on that ascending triangle. I do think we'll see another 10% or so tacked on, maybe a little bit more than that, depending on exactly how you draw that measurement line. But this is definitely I think, a time in the market, and many of the signals that we're getting right now, to me, suggest we're going higher. And it may be at the expense of some of the reopening stocks. I mean, we have had so much rotation in this market. It's kind of dizzying, much more so than usual. I mean, in bull markets, you always have rotation, but you don't have pandemic lows and in all these various industry groups that were hit so hard and then all of a sudden have a huge surge in demand. And then this has just been a weird 18 months. I think everybody probably would agree with me on that in terms of trying to figure out the market's next move. But I do think once we get through probably the next quarter or two, I think things will start to go back to normal and I think become much more reliable again in terms of what the true leaders are, not have these massive wild swings back and forth. The volatility's been kind of crazy in terms of the rotation. Anyhow, that's it for me. Appreciate everybody tuning in. We'll do another episode of Trading Places Live over at Stock Charts TV starting at 9 a.m. Eastern on Thursday. Hopefully you can join me over there. Everybody have a great day. Happy trading.